Every time we've seen a recession over the last century, the same three things have happened each and every time. Number one, some people become incredibly rich and richer than we've ever seen before. Number two, lower income people feel poorer and left out of the system. And number three, you're seeing a growing divide between the rich and the poor, and this creates more unrest. Just take a look at our most recent example with the 2020 pandemic. We saw the wealth of some people grow to levels that we have never seen before at some of the fastest rates ever. At the same time, we saw some people become much poorer because of the pandemic, because of the economic slowdown, and this growing divide between the rich and the poor fueled the fight for a wealth tax against some of the richest Americans out there. Take a look at what happened after the 2008 recession. We saw the wealthy and the financially educated become richer and wealthier than ever after the recession. At the same time, we saw lower income Americans and even the middle class feel poorer after the recession, and this led to even more social unrest because of it. There's three factors contributing to the rich becoming richer, the poor becoming poorer, and then the middle class essentially getting wiped out with a bigger divide between the rich and the poor. And the first has to do with the basic levels of financial education. There's three aspects to our economic system. You have consumers, and this can be rich people, poor people, middle class people. Everybody is a consumer. Then we have the economy, which is made up of businesses and the business owners and the entrepreneurs. And then we have the investors, which own a piece of the economy. Now, when you see an economic slowdown, what happens? Consumers no longer have the ability to spend because incomes are falling, which means the economy is hurting, which means investments go on sale. In the 2020 pandemic, we saw the stock market get hurt. We saw the cryptocurrency market get hurt. In the 2008 pandemic, we saw the real estate market get hurt. We saw the stock market get hurt. We saw businesses go on sale. And so this creates opportunities now for people who are financially educated and prepared to capitalize on these opportunities. What does that mean? It means that people who have money can go out and now buy some of these investments at a discounted price. You can buy something that makes you money when it's on sale. So in the 2020 pandemic, people were able to buy stocks on the stock market for 30 to 50% off. In the 2008 crash, people were able to buy stocks for 60% off. You were able to buy real estate for 60, 70, 80, even 90% off. This allows now investors to come in who have money, buy these investments, and now ride up the economic wave and make a lot of money very quickly. Versus people who, one, don't understand this, don't do it. And people who don't have the money to do this can't do it. The average person is working for a bigger salary. They're not working to own more assets. And when you see these types of recessions, rich people get excited. Financially educated people get excited because they want to go out and buy as many assets as possible. And then what happens isn't that these rich people's salaries go through the roof, is that the value of their investments, so the value of their wealth, goes up because now the value of their investments also rise. Their assets become more valuable, so they become wealthier. And what poor people and the middle class people and financially uneducated people are saying is, what the heck? We keep hearing about on the news about how rich people and wealthy people keep becoming richer and richer and richer after this recession. Well, we're not able to keep up. And it's not because rich people's salaries are skyrocketing, although you might hear about CEOs getting these big bonuses and all that other stuff. But for the majority of it, 98% of people who see this meteoric wealth rise after a recession, it's not because salaries are going up. It's because their wealth is increasing. And the reason why their wealth is increasing is because they were able to go out and buy these assets for pennies on the dollar, and then they saw the value of their assets go up. So they became wealthier on paper, not a bigger paycheck, which is how the majority of people are working to earn their wealth. The majority of people are working to earn a paycheck, while the wealthy are working to own the means of production. The wealthy are working to own the machine that prints the paycheck. That's the first part. The wealthy people go out and they buy these assets and investments at a discounted price, while the majority of people are working to see their salaries grow. But this first part isn't complete without the second part, which is when you see this type of economic slowdown or recession happens, the next thing that happens is you see the entities in charge, the government and the Federal Reserve Bank, who want to pull our economy out of this recession. How do they do that? They stimulate the economy. Now, how do you stimulate the economy? This might be through interest rate cuts. You cut interest rates, mortgage rates, which makes people want to go out and buy a home, which helps to boost the economy, which puts more dollars into the economy. The government might send out stimulus checks. The Federal Reserve Bank might bail out the stock market. You see more money being printed. You see more dollars enter our economy. Now, notice what is said here, that they want to stimulate the economy. If you remember what I said just a second ago, how there's three aspects to our economy. We have consumers, we have the economy, and we have investors. If you stimulate the economy, that means the economy grows. Who owns a piece of the economy? It's not consumers, it's the investors. Investors own a piece of the economy because investors are owning a piece of the business. Consumers are people who work in the economy. They don't own the economy. Now, you can work in the economy and own a piece of the economy because everybody's a consumer, but not everybody is an investor. But this is where now understanding how these external forces like the government and the Federal Reserve Bank come into play, because the government and the Federal Reserve Bank now want to stimulate the economy. And they can make it seem like they want to help regular people. We want to send out stimulus checks to help out American people. We want to cut interest rates to make it more affordable for people to buy a home. We want to cut interest rates so people can go out and finally finance the car of their dreams. When in reality, what they're trying to do is stimulate the economy. How do you stimulate the economy? You encourage people to spend. When consumers spend more money, this is all people, poor people, middle class people, rich people. When people spend more money, the economy grows. When the economy grows, who benefits? People who own the economy. Who owns the economy? This is the business owners and the investors. Now, not everybody can be a business owner, but everybody can be an investor. This is why financial education is so important, because anybody can start being an investor and start owning a piece of the economy with as little as $100, even $10. And so now what happens? You have the financially educated and the wealthy. When they see a recession, they go out and they buy assets at a discounted price. Poor people, the middle class, people who are not financially educated, are hoping that they're going to see an increase in their salary. And maybe you see a little bit of an increase in your salary, but then you see the government go out and they start stimulating the economy, meaning they want to grow the economy. And they might say that they want to help consumers, but now what they're really trying to do is they're trying to encourage people to spend money. Now you spend money, you see more spending happen, the economy starts to grow. Consumers don't feel richer because now their expenses are higher. The economy starts to move again. The economy starts to grow. And now investors see their wealth skyrocket. Why? Because the value of their investments, the value of their assets start to grow. Then you have the final piece of the puzzle, which is the final blow to the average American. So right now we have a recession happens, and then wealthy people go out and they start buying these assets at a distressed price, meaning they buy assets at discounts. Then you see the government and the Federal Reserve Bank come in, who stimulate the economy. Who does that benefit? It benefits the people who are financially educated, who own a piece of the economy. Then you see this hidden tax. You have the tax that needs to be paid to cover the government's expenses and the Federal Reserve Bank's expenses. We saw this happen in 2020. We saw this happen in 2008. We saw this happen in 2001. This happens in every recession, where now the government and the Federal Reserve Bank want to pull our economy out of this mess. The way they do that is by stimulating. The way you stimulate is by creating more money. How do you create more money? One is by lowering interest rates, and two is by flooding our economy with money. Now, there's a consequence to this money printing and money producing. That consequence is a hidden tax, because the most expensive kind of money is free money. Somebody has to pay the price for this money somehow. Either the government can raise your taxes, because remember, the government doesn't produce an income. The government taxes you. You go to work every single day, you pay a tax. You buy a home, you pay a tax. You buy a car, you pay a tax. The government gets their money from taxes. And if they spend more money than they bring in from taxes, they have to cover that loss somehow. How do they do that? Well, they can just print that money. But if you just print money, then why do we have to pay taxes? I mean, there has to be some sort of consequence to printing money, and there is. And that consequence is the hidden tax. It's inflation. When you print more money through the form of stimulus, whether it's through cutting interest rates, whether it's through sending out stimulus checks, whether it's through printing free money and blowing up the stock market, all these things have a consequence, because now you're printing more money without producing more wealth. And when you print more money without producing more wealth, now the value of each individual dollar goes down, causing the price of things to go up. This is inflation. And inflation disproportionately benefits the wealthy and the financially educated, and it disproportionately hurts the financially uneducated and the middle class and the poor. Why? Because most people don't understand how inflation works. And if you don't understand how inflation works, then you're the one that's paying the price of inflation. Because now as the value of the dollar drops, the price of things go up. So now you might get a raise from your job because that's what the average person is working towards. The average person isn't working to own assets. The average person isn't working to be an investor. The average person is working towards a raise. Now maybe you get a raise and you feel a little bit richer initially, but then you realize that your raise isn't enough to keep up with your higher rent costs. It's not enough to keep up with the higher housing costs. It's not enough to keep up with car prices rising. It's not enough to keep up with egg prices rising. It's not enough to keep up with the travel costs rising. And this is why we have seen the poor and the middle class become poorer through each recession, not because the rich are buying assets, but because now the thing that's working to grow the valuation of these assets, the money printing, is making the dollar less valuable. And so now what happens? You have the rich, the financially educated who are buying these assets. People who understand the system, they're buying the assets. They go out and buy them at a discounted price. Then the government goes out and they try to stimulate the economy. This benefits the asset owners, the business owners, the investors. Anybody can be an investor, which is why you want to be financially educated. And then the consequence of stimulating the economy is that the value of the dollar goes down, meaning it's paid for by the average American, people who don't understand how money works, people who don't understand financial education, people who don't understand how inflation works. Now you pay the hidden tax. And up until before the 2020 pandemic, inflation was at around 2% a year. And the reason why the Federal Reserve Bank says that they want to keep an inflation target of around 2% a year is because in their eyes, that's just enough inflation to continue to grow the economy, which benefits investors, without alarming consumers, without alarming regular people. So they want enough inflation to keep investors and the economy growing and booming, without really causing much concern for the average person. And this is where now when you see this inflation happen, your savings aren't as valuable, your salary doesn't stretch as far, and this is why today in this new economy, you need 2-income households to barely be able to afford a home, to barely be able to afford a car, to barely be able to go on vacation, to barely be able to pay for your student loans, versus in the 1970s, 1 income was able to buy a home. 1 income was able to buy a car. 1 income was able to pay for college. It's a completely different economy. And the reason why this is happening is because we have the hidden tax, which is inflation, which is fueling the average person becoming poorer because now your salary is dropping. And even if you get a raise, it's not enough to keep up with the growing inflation. Now, this is why you want to be financially educated. That way you can be one of the people that understands this and benefits from the way that the system works, because you have to learn the rules to money. That way you can benefit from the way that the system works, because if you don't learn the rules to this, you're going to be one of the people that's just a pawn in the game. And this is where I want you to be more financially educated. And this starts by first is understanding what's happening in the financial world. Now, I have a ton of videos on my channel where I talk about this. You can also join Market Briefs, which is my free financial newsletter, where every day my team is working to break down what's happening in things like our economy, the stock market, the housing market, crypto, and the global economy into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning. And even if you don't have a financial background, I promise you, you're going to look forward to reading Market Briefs every morning. So if you haven't joined Market Briefs yet, I'll put the link to how you can join down in the description below. Last year, my accountant kept telling me to buy a G-Wagon. Why a G-Wagon? Because he said that we could justify that if I bought a G-Wagon, he could say to the IRS, look, Jaspreet is an influencer. He needs to maintain his image as an influencer. How can he do that? Well, he can buy a G-Wagon, and now this G-Wagon is a tax deduction for him. Now, did I